At age 92, Ronald Read passed away quietly, leaving behind what appeared to be a modest life. He drove an old, beat-up car, wore worn-out clothes, and worked as a janitor. But when the truth emerged after his death, jaws dropped. Ronald had secretly amassed a fortune of over $8 million. How? Through the incredible power of compound interest. But Ronald's story isn't unique. In fact, anyone can become a millionaire through compounding, even you. And it's simpler than you think. So, what's the magic behind compound interest that turned a janitor into a multimillionaire? Think of compound interest like a snowball rolling down a hill. At first it's small, barely noticeable. But as it rolls further, it picks up more snow, growing bigger and faster with each turn. Compound interest works the same way. The interest you earn on your money earns even more interest, creating exponential growth. Here's how it breaks down. Let's say you invest $1,000 at a 10% annual interest rate. After 1 year, you'll have $1,100. Simple enough, but here's where things get interesting. In the second year, you earn interest not just on your original $1,000, but also on the extra $100 you've already earned. Now your investment grows to $1,210. By year 3, your money has grown even faster, reaching $1,331. But this is just scratching the surface. To truly understand the unbelievable potential of compound interest, we have to go deeper. And it all begins with time. When it comes to compound interest, time is your best friend. The earlier you start, the more your money multiplies. Let's meet Sarah and Mike, both eager to retire as millionaires. Sarah starts investing at age 20, putting away just $200 every month. Mike waits until he's 35 but invests $400 every month, double what Sarah puts in. Fast forward to retirement at age 65, and Sarah's account has ballooned to over $1.3 million. Mike, despite investing more money overall, has only about $600,000. The secret? Sarah gave her money more time to compound. Even though she invested less each month, the head start was enough to double Mike's total. But what if you're not 20 anymore? Is it too late? Absolutely not, and here's how you can catch up. So you missed the early train? No worries. You can still supercharge compound interest by making strategic moves to accelerate your gains. This is where reinvesting dividends comes into play. Dividends are profits that companies pay their shareholders, usually every 3 months. When you reinvest dividends, you're essentially adding fuel to your compounding fire. Take Coca-Cola, for example. Investing just $5,000 in Coca-Cola stock in 1990 without reinvesting dividends would give you around $55,000 today. Not bad, right? But here's the kicker. Reinvesting those dividends would balloon your investment to over $140,000. Nearly triple the amount, all by simply putting dividends back into buying more shares. But dividends aren't the only turbocharger you can use. There's another powerful technique that many investors overlook, and it's about to completely transform your compounding journey. Increasing your investment contributions regularly is like adding rocket boosters to your financial rocket ship. Let's look at John, who started investing just $300 per month in an S&P 500 index fund. Initially, he's on track to retire comfortably, but John decides to increase his monthly investment by just 5% each year. This means in year 2, he's investing $315 per month, then $331 the next year, and so on. After 30 years, instead of retiring with roughly $680,000, John ends up with more than $1.1 million. That simple decision to slightly increase his contributions annually nearly doubled his retirement nest egg. Small, incremental increases can create massive results when paired with compound interest. But what happens when compounding isn't managed wisely? That's when things can go surprisingly wrong. Compound interest isn't always your ally. It can also be your worst enemy. Credit card debt is a perfect example. Let's say you owe $5,000 on a credit card with a 20% annual interest rate and make only minimum payments. Because interest compounds daily, your debt balloons rapidly. Over 10 years, you might end up paying back double or triple what you initially borrowed. Understanding this dark side of compound interest is critical. The very force that can create immense wealth can just as quickly trap you in debt if mismanaged. Avoiding high-interest debt and paying it off quickly isn't just good advice. It's essential for keeping compound interest working for you, not against you. But how realistic is becoming a millionaire purely through compound interest? The truth might surprise you. Ronald Read isn't alone. Grace Groner, a secretary at Abbott Labs, invested just $180 in the company's stock back in 1935. When she passed away in 2010, her small initial investment had exploded to over $7 million. She didn't actively trade stocks or follow complicated strategies. She simply allowed the dividends and compound interest to work quietly in the background. Another investor, Ann Scheiber, started investing later in life at age 51 with just $5,000. By the time she died at age 101, her investments had compounded to a staggering $22 million, which she generously left to charity. Warren Buffett, one of the richest people in the world, is another perfect example. While he started investing young, most of his wealth accumulated after he turned 60. Buffett was worth about $3.8 billion at age 59. But thanks to compound interest, his net worth skyrocketed to over $100 billion by age 90. Compounding wasn't just a factor in Buffett's success, it was the driving force. To truly harness compound interest, understanding your investment options is crucial. Stocks, bonds, index funds, ETFs, each offers different benefits and risks. A stock represents ownership in a company like Google or Amazon. When you purchase a stock, you essentially own a tiny portion of that business. If the company grows and increases its profits, your shares typically become more valuable, and sometimes the company will pay you extra money called dividends. However, if the company faces difficulties, your shares might lose value. An index fund is a simple investment designed to mirror the performance of a specific group of companies. Imagine a large basket that contains small bits of hundreds of companies, selected to match a particular list or index, such as the Dow Jones Industrial Average, which tracks 30 major U.S. companies. When you invest in an index fund, your money spreads out across these companies. So, if one company struggles, others in the basket can help balance out your investment. This type of fund offers beginners an easy, low-cost way to steadily grow their money over time. For example, investing in the Fidelity 500 Index Fund, which tracks the S&P 500, might yield around a 10% average annual return over long periods. Alternatively, a bond-focused investment like the iShares Core US Aggregate Bond ETF could return about 4% per year. By combining these different types of investments strategically, you can build a balanced portfolio that enhances growth while controlling risk. An ETF, or exchange-traded fund, combines the advantages of stocks and index funds. They can track broad sectors like large or mid-sized companies, or specific sectors like technology, healthcare, energy, or even green energy. Like an index fund, it lets you own small parts of many different companies at once, which helps lower your risk. But ETFs trade like regular stocks. You can buy or sell them anytime during the trading day. Think of an ETF as a grocery cart filled with lots of different food items, each item representing a different company. When you buy an ETF, you get a little bit of everything in the cart all at once. A popular ETF is the Invesco QQQ ETF, which tracks the NASDAQ 100, allowing you to easily and affordably invest in 100 large tech-focused companies at once. Or the SPDR S&P 500 ETF, which tracks the S&P 500. Bonds typically offer lower returns, but provide stability and regular interest payments, which can be reinvested. The road to becoming a millionaire isn't about flashy investments or insider secrets. It's about harnessing the quiet, steady force of compound interest. Whether you start at 20 or 40, whether you invest big or small, the principle remains the same. Consistent, patient investing grows your money exponentially. So if you dream of financial independence, remember Ronald, Grace, Ann, and Buffett, because with compound interest on your side, Anyone can turn a modest start into a millionaire finish.